Hey, this is Ronald from Tech.eu, and I'm joined here remotely, of course, as per usual, by Mauricio Magaldi from a company called 11FS. And we're going to talk about how Web3 is changing the future of finance, which is a report that Mauricio actually authored very recently, quite a comprehensive report. We're going to talk all about that in a minute. But before that, Mauricio, can you tell us a little bit about yourself and 11FS?
Absolutely. Thanks for having me, Robin. Pleasure to be with you guys today. I've been with 11FS for around 6 months. We started to put together what we call the Web3 crypto practice in the consulting arm, which is 11FS Ventures. 11FS is a challenger consulting company, 6 years old, specialized in financial services, hence the FS in the name. We mostly do fintech and neobanks for our corporate clients, and with me arriving, we're also servicing crypto native companies and incumbents that want to dip their toes into crypto, Web3, DeFi, etc. My background is in financial services. I've been in the industry for over 20 years. Started off in Brazil, where I spent most of my career. Covered a lot of Latin America. Pioneered Latin America blockchain services with IBM back in 2017. So I've been around crypto and blockchain for some years now. Have been gone through the whole crypto winter and summer cycles for some time now. But it's a great opportunity to actually help build a new internet. So yeah, we're just super excited about Web3 and crypto in general.
Great, fantastic. Well, thanks again for joining us. As I mentioned, we are going to talk about your report, I'd say.
Our
you're the main
report.
author of it. Your report. But it's called How Web3 is Shaping the Future of Finance. There is quite a lot to unpack in it. But maybe let's first talk about the reason why this report exists in the first place. What was sort of the reasoning behind putting it together?
Great, yeah. So, we talked to a lot of clients, right? I mean, we've been talking to regulators, banks, fintechs, crypto natives, and we saw a lot of gap in understanding, I'd say, of what these things are, what are the primitives, what they mean for businesses and users. And the questions were all kind of the same. So we felt the need to kind of put together something that would be take the conversation to the next level, right? Instead of just having the first conversation explaining how we see Web3 and crypto and DeFi, why not start a level above by having them, handing them an interesting, easy to read material that they can take anywhere, that then would start a conversation at a level above and move faster towards, maybe thinking about a project together, maybe putting some partnerships together with other Web3 providers. So I think the overall goal is to actually level set knowledge, because I think education is a big chunk of what we do in the industry right now, but also to help people understand what this is, what are the impacts, how they can tackle the opportunity if they so choose. And I think to that extent, I think we're very successful because the questions now have changed. People who have read the report are now asking more sophisticated questions for us. So we are actually starting off at a much more advanced level of the conversation, which helps everybody, right? You kind of shortcutting into stuff that's really valuable to the business, and not only, what the hell is this that's happening? Now they can read through. The report is easy to navigate. There's a lot of choose your own adventure type of navigation there, which we kind of did on purpose because we knew that the subject is self-referencing. So yeah, I think that was probably the most mundane reason. It was not to be one of the the companies to define what Web3 is. I don't think that was the goal, but the goal was to kind of bring our definition to the dialogues that we're having with the industry.
Yeah, this is sort of the problem that I see also talking to people sort of outside of tech, that these terms are changed, are used interchangeably, like Web3, Metaverse, crypto, NFT. For a lot of people, all of that's basically the same thing, which of course it isn't. So the report does go to great lengths in the beginning, especially to sort of outline what's a wallet, what's a token, what is Web3 for us. Because Web3 is in the title of it, maybe just sort of shortly explain how you as 11FS, of course, see Web3 and sort of why is it the next evolution of the web and how is it different?
So I think one distinction we wanted to kind of bring forth with the report is the Web3 is not crypto, but it includes crypto, right? Web3 includes metaverse. It includes things that are being built with blockchain and crypto in mind, or as a primitive, but it's not necessarily interchangeable. So if you say Web3, in our minds, we're talking about all of that, all of the new internet, whether it's immersive, whether it's X to earn, right? Move to earn, play to earn, whatever you do to earn. It's the internet of incentives because everything now is incentivized in a financialized way. Is also crypto and cryptocurrencies, and it's also stable coins, and it's also NFTs. So I think the the idea of Web3, especially because it kind of serves well the palette of the non-initiated in crypto, the non-natives. I think it kind of eases in the conversation of Web3. I'm used to the web, right? The web. What is it that you call Web3? And then there's a lot more curiosity. Whereas in crypto, it still carries the bad branding. If you check the recent mainstream media podcasts and headlines, everyone is like, oh, the crypto winter this, the crypto winter that, but nobody's talking about the Web3 winter because it's become easier to lash out on crypto because it's speculative, everything's a Ponzi scheme. And the way we see this is for the technology and the enablement that these technologies bring to financial services in general. Obviously, there's other industries being impacted, but we focus mostly in financial services. So the way we see Web3, and we call it a glow up, right? It's a more palatable way of addressing all of the business models and opportunities that are enabled by cryptocurrency-like technologies, plus other technologies, obviously, that then become this now the web of ownership, the web of incentives, and this is why we kind of referenced the Web3 report and not the crypto report, because we understand that there's been a shift in narrative, but it's to ease on the conversation, and it helps everyone understand that this is not for the sake of speculation. This is for the sake of using new technology with new primitives to actually build a different internet.
Okay. Finance, of course, touches everyone, ranging from individuals to businesses. But for individuals specifically, for my mom, your mom, join the street, why should they care? Why should they care about Web3 and the way it is actually changing the...
So I think one of the big gaps right now for crypto Web3 in general is UX, right? If you try to use any decentralized application, or the dApps as we call it, you'll have a hard time. Nothing is intuitive. There's a lot of coding in your face, like 0x some things, and this has been tackled by the industry already. So there are pockets of builders building to fix that. That's what I think is the first hurdle to your mom, my mom, or whoever's mom is trying to use these things. But the real benefit is almost underlying what we do. What crypto and Web3 in general offers is that now you own your data concretely because you hold your private keys to the data that's stored in blockchains. And you can take your data with you anywhere. Right, so it's not like my mom is using Facebook and her data now belongs to Mark Zuckerberg and his, and his companies. And if she wants to do anything with that data, well, now she has to ask permission to the platform to use that. So she goes to the platform, she volunteers her data, and that is now how she interacts with the world, because now the platform through which she interacts with the world owns her data. We usually say that if the service is free, the product is you, which is what social media kind of turned into. With Web3, you have the keys to your data. Your data is stored in the blockchain. No one can touch your data unless you let them through authorizing transactions. And now platforms come to you. And everything you amass through your usage of Web3 is now your own property. You can take it anywhere with you. And you can revoke access at any point in time, because you own the private keys to that. Obviously, the upside is you become your own bank. You now have control of your finances, your identity, your collectibles if you have NFTs and stuff like that. But with great power comes great responsibility, like one character of a very famous Marvel comic would say.
Which we shall not name.
Yeah, we're not advertising any of that. But now being your own bank comes with being a bank responsibility. So we're still in that era of seeing under the hood. We're kind of like in 1991 for the Web 1, I think, because we're seeing the codes and the IPs and all of the underlying under the hood bits and pieces as we move towards a more sophistication of Web3 tooling and applications. These things are going to fade into the background, because once the technology really works, what we see is that it fades in the background. We don't know. I've used my cell phone this morning, and I don't know which dynamic IP it's going through in the internet, because it doesn't really matter. It's going to be a time until we get to a point where it doesn't really matter which blockchain we're using, because it's fading into the background, and it's just how we do things, right? So for the regular user, it's still early days of 1991, and I don't remember my mom using the internet in 1991, but eventually she came around, and now she's obviously using her cell phone for whatever she wants to do with a bank, whatever she wants to do with a game or talk to her grandsons. But we're going to get there. So when we say that we're early in the industry, it's not that we're early because if we enter now we're going to make a lot of money. We're early in the industry because there's still a lot to build. So and this interface and this UX that we're seeing as a big hurdle to adoption is right now, as we speak, being tackled by very smart people.
Right. So what you're saying is the groundwork is now being laid. We were sort of in between the individuals and companies building the Web3. We're putting together a foundation for eventual mainstream adoption of these technologies. So I can relate to that. I understand. What does it mean for businesses, or should businesses already engage with that today when they're not necessarily Web3 native?
Yeah, I think for businesses in general, the big opportunity is helping influence what gets built and how. Right? If you're a services company or a technology company, being able to be in a position to help develop the new internet, the internet of value, as Don Tapscott would name it, is a big opportunity. Even if you're not a core participant of this, you might want to be able to influence how these things play out, both in terms of how things get built and also how things get regulated. I know that I don't speak for the industry here, because crypto is inherently anarchical, and that's the ethos of original cypherpunks. But I don't see this getting massive adoption without proper regulation. And when I say proper regulation, it's not just telling people what to do and telling people what not to do, but also the regulators being able to be present on chain, being able to use the data that's on the blockchain, and be able to use the technology primitives from crypto and Web3 in their own benefit and in the benefit of the industry. So if you're a company and you're trying to build in the space, interacting with your the regulator of your sector or subsector of the economy is not something you would want to forfeit, not at this stage at least, right? I think collaboration, the name of the game is collaboration. Blockchain as a technology itself is a technology that promotes and fosters collaboration across participants, be it the miner, a validator, or even the users. So it is important, if you're a company, to actually consider how these technologies and these new primitives change your relationship with your customer base, with your suppliers, how much more efficient you can get by just adopting some of these things into how you do business. And when doing so, collaborate with your regulator. We're seeing innovation sandboxes being launched by regulators all over the world. both focused on crypto and also focused on everything else like instant payments and identity management and AI and machine learning. And I think the big jurisdictions that are interested in evolving the marketplace are going to be very interested in understanding what the regulated companies are trying to do with this new set of technology primitives. And if they run away, if regulators push it away, what's going to happen, because this technology is global, digital, and works 24/7, is that they can do this anywhere in the world. Like, there's no boundary; it's borderless. Crypto as an infrastructure doesn't require you to be anywhere specifically, so you can find a place where the jurisdiction will be more friendly, which kind of plays against regulators because they don't like regulatory arbitrage, which I fully understand. But if you're a regulator and you don't want this to happen, you might just want to sit with your regulated entities and discuss, how to tackle this in controlled, progressive, gradually evolving way, so you don't get left out of the global economy. Because I don't think Web3 is going anywhere.
Right. So what you're essentially saying is that it's in the interest of regulators to, before thinking to engage with the community, to try to come up with rules and regulations that work for everyone. I hear from the industry quite a lot that they welcome regulation. At the very least, the boundaries are set, and they can sort of discuss and help shape it if you're in dialogue with these regulators. At the same time, I participated in Brussels Blockchain Week just a few weeks ago, with the new legislation in Europe, which was not adopted then. The MiCA regulation wasn't really adopted yet, but everyone knew it was coming. And I heard nothing but criticism, literally nothing but, this is really bad for us and we'll just take our business elsewhere, etc. How do you sort of, specifically MiCA, the regulations that we have here in Europe, what's your opinion on that?
I think there's nuance between a law and a regulation, right? Once it's written as a law, then it needs to get implemented. And even banking regulations, when you see the law that's supporting banking regulations, they're very strict. Like, they're very demanding. They require a lot of, regulatory compliance, observation efforts. But when you go through the implementation of that as a regulation, there's nuance, right? If you're a big company, you have big requirements. If you're a small company, well, you have smaller requirements, you have less requirements. You can play a little more leeway within the borderlines of the regulation. So I think this is something we'll probably see, and in the crypto space, what we'll see is that the big exchanges, the ones that are making tons of money, will have higher standards to be attained than, say, a crypto startup that's doing like one DeFi protocol to kind of yield farm something within derivatives and stuff like that. So I think, and if it doesn't come that way, what's going to happen is people are going to just lift and shift. That is exactly what's going to happen. But when I say regulation, I don't mean just the lines that are written on a PDF somewhere. Regulatory integration is what's going to change the game. The stance of regulators, instead of just regulating from the sidelines, to actually go and participate on chain. And when I say this, is that there's a lot of transactions on chain that they can start doing their own reporting because the data is public. The data is out there. Ethereum is a public blockchain. Bitcoin is a public blockchain. Solana is a public blockchain. Everyone that's building a public blockchain can offer regulators a ton of data that right now in the existing traditional financial services don't exist. You can't have that degree in timeliness of data access to transactional data in the traditional financial system. You just can't. It's not available. It's on a mainframe somewhere. It's on a cloud somewhere. And the regulators need the banks or the regulated entities to provide them with reports, which happen between, 30, 60, 90 days after the fact. So when I say regulatory integration, is also regulators coming in and using the data that's on chain in their favor. In an extreme example, if we had all the CDSs and mortgage-backed securities from 2008 recorded on chain for everyone to see in a timely manner, it's really likely that we wouldn't have faced the 2008 crisis, because everything would be available for analysis further on, instead of having to wait for 3 or 4 weeks to see the data all across the world of whose derivative was being held by whom, right? So I think that that's one aspect. The second aspect is Web3 technology is programmable. You can program the behavior of assets in ways that are immutable and transparent. Everyone can see what's being coded. So if you're a regulator, my claim to you is write your own software development kit with the rules that you want to see standardized and offer that as a resource to the companies. So now that if I'm a builder, I can use your SDK on my software and make it completely compliant without much effort, because now you're using a piece of software within my smart contract to actually go and build something new within your regulation. It's not going to allow me to do some weird thing that is non-regulated because I'm using a piece of the software that prevents me from doing that. But it will expedite my my time to market, because now I'm using the foundation of the regulation. You won't see regulators coming into a bank and say, I want to code a piece of your software. But in crypto, you can, because it's public, because it's permissionless, because it's programmable. So I think the opportunity for regulators to change the stance and actually dive into the very infrastructure that they're trying to help regulate is a game changer for the industry, which I haven't seen any examples of this up until now, but I'm willing to be proven wrong. If there's a regulator that comes in, hey, we coded an SDK and we're using on-chain analytics to do this, that, and the other thing, that would be great. That would be great. And I would bet that this would attract more builders to that jurisdiction than anything else, because now they can speak the same language, because they know that the regulator understands what is it to build for a blockchain, how it works, what are the challenges. So I think experimentation at the stage we're in is fundamental, and it's not only for companies, it's also for regulators. So I would love to see this, because I think that this is going to be a game changer. Yes, it will require the regulators to change their stance, but I think it would be to the benefit of all, both the industry and obviously the regulators, because if we're in the age of data and blockchains offer you all the transactional data that you might want to regulate, I think it's kind of a perfect storm, if you ask me. So I think it's a big opportunity, and I would love to see that happening.
Yeah, definitely with you there. I'd love to see some examples of that sort of forward thinking by regulators across the world. Until then, we'll have to do with what we have today. We talked about this foundation of the Web3, and especially when it comes to finance being laid. I think the core of it, and something that's inherent sort of to the blockchain technology in itself, is decentralization. You already mentioned DeFi sort of became the term to wrap everything decentralized finance under that name. What does it mean, and what does it mean for the financial services giants of this world? The banks, the insurance companies, any financial service company that was around before blockchain. How do they need to look at this sort of wave of decentralization, and how can they cope with it?
We kind of break decentralization in the report as a spectrum, right? Not everything can be fully decentralized. Not everything needs to be fully centralized. I think we'll see different use cases across the spectrum depending on where they are in the value chain of financial services, and depending on where they are in the technology stack. So if you think about, say, a user access application, such as a wallet or a website, if it's fully decentralized, the time for it to load and process is just too long, right? Because it has to go everywhere and come back from everywhere, and that doesn't lend itself well for good UX. So at that point, I don't think we're going to see things being too decentralized. So that is one angle. Obviously, when you go down the stack and you have the very data foundation, the more decentralized, the better, because then you have censorship resistance, you have resilience, you have redundancy, and you have persistence of the data, and you might not need crazy throughputs for loads of transactions, because you can settle them in micro batches. So it kind of helps you stabilize the foundation if you're more decentralized. When it comes to business, there is a potential trade-off between being centralized and achieving economies of scale, therefore being very profitable, and being very decentralized and achieving network effects, which kind of dilutes how much you can accumulate in terms of value individually. But the total would probably be bigger than if you concentrated that power. So for every point in the financial services value chain, we'll probably see different approaches to decentralization and to using decentralized infrastructure depending on where you are. So one example I really like is in receivables, right? If you have a cash flow, a future cash flow, and you want to right now you want to offer that as a collateral to take a loan at a bank, the process is immense. There's a lot of verification. There's obviously lack of transparency. Which assets are you talking about? But if you lay it on top of decentralized infrastructure, which will lend itself to the final entity in this process, see what's happening in the first entity of this process, and everyone in between can see what they need to see to actually perform their jobs better, then the degree of efficiency is so much bigger. And not only that, because every one of these assets are now tokenized within the blockchain, they can be offered to a secondary market with much more liquidity. So in a sense, when we see this value chain, not everything needs to be decentralized. So a bank could take part on all of that. And as a matter of fact, banks are starting to use funding from DeFi protocols to actually perform real-world transactions. So recently, MakerDAO made a trade finance operation using a centrifuge DeFi protocol. MakerDAO is one of the oldest DAOs, the decentralized autonomous organization on crypto, and they issued the stablecoin called DAI, which is pegged to the US dollar. But what they did is that they financed the export of beef between Australia and Hong Kong. This is traditional finance, like 101, right? But they did it with the funding coming through crypto. And the overall process was tracked with another blockchain to see where the beef was going, where it was headed, the bill of lading, etc. So everything became more efficient because there was this wealth of Web3 technologies being used to underpin the whole process. And each of them had a different position in the decentralized spectrum. The blockchain that's used to track the beef is not as decentralized as Ethereum, which is used to hold the DAI in a vault, so it can pay for the invoice. So it's all different pieces of technology coming together, and each of them will play a part because each of them will have a specific place on this spectrum that they can play for specific use cases. So I think in terms of being a traditional financial services company and looking into this, you won't become a DAO. if that's the fear, then don't become a DAO. You don't need to. But can you use these technology primitives to actually offer a better service, a more decentralized service, maybe even a cheaper service overall that you can maybe share the profit or the efficiency with your stakeholders? Well, yes. And if you don't experiment, you'll never know, because this is the time where you're going to say, well, this works for me and this doesn't. What doesn't. You don't need to use everything, but you'll use what actually works for you and maybe help influence the way your regulator is seeing, well, yes, this is crypto, but it's not cryptocurrency. We're funding traditional trade finance operations with the whole infrastructure, right? So I think the degree in which we know what can be done is only going to be defined by the amount of experimentation that we actually perform.
Great. And experimentation we will have, I'm sure. What I like about the report as well is that you talk about the risks. You don't shy away of talking about the risks involved. Without summarizing the entire section, what are some key elements of risk that you want to highlight here?
I think if you're using any of the public blockchain crypto infrastructure, you're probably going to be exposed to volatility, because the underpinning asset that you need to use to actually make the blockchain work for you is volatile. And the reason why it's volatile is because it's the first time in history we can price technology in real time as we use it. you can use an IBM mainframe and they will give you a price for that. You can use a Google Big Table and they'll give you a price for that. With blockchain, they will give you a price for that as soon as you want to use it, and you're going to have to use the native asset of that blockchain to actually perform the activity. So, and that asset is traded 24/7, real time, digitally, globally at any point. So that is one risk, and the predictability of that is even riskier than just the price of the cost of using the blockchain. That's why we're seeing other forms of addressing that with what we call the layer 2 blockchains, which are blockchains that are cheaper, faster to use, maybe not as decentralized as a layer 1 such as Ethereum, but it will perform all of these functions similarly with faster processing time and cheaper costs, and then it will roll into the layer 1 blockchain to facilitate that. So I think volatility is one risk that I would certainly consider. The second, I think, is the smart contract risk. Smart contracts are software programs that we write, we humans write, and we make mistakes. So there's a lot of audit that goes on and testing. The most successful DeFi protocols never stop testing. They're always testing, even after it's launched. They keep testing, they keep stressing. And I think that this is one of those things that DeFi brought in from enterprise-grade software that never stops testing, which I think is great. And it has to be that way because it's a very dynamic world. And because Web3 is also permissionless and composable, if someone is using your token for something else, and your token presents a behavior that you didn't forecast on your programming, you need to keep testing because there's other uses from your own assets you didn't foresee and you didn't plan for it. So you need to continuously test, which is what will probably make this industry much more resilient than anything we've seen in history. So I think smart contract risk is another. So if you're using any of this technology, never stop testing, never stop auditing. There's a lot of bounty programs out there for the major protocols. Bounty programs are rewards program if you're a quote-unquote white hacker and you go and find a flaw or a breach in any of these softwares, you get paid for that. If you don't announce it to the hacker world before anything else, if you go straight back to the protocol, say I found a glitch on your program, here it is, fix it. They'll pay you a reward, and sometimes will pay you handsomely. So I think smart contracts are a specific risk that needs to be tackled. There's also an emerging industry on the back of that, which is the insurance industry. You can now insure if your smart contract has a glitch that you didn't, your audit didn't pick up, or for whatever reason your tests didn't pick up, and a user happens to have a problem with your smart contract, you can trigger a claim on an insurer to actually pay the claim back to the user that had the problem. So I think there's a lot of alternatives to tackle that, but it's still a risk. If you don't do anything, it's still a risk, right? And I think the third risk in all of this is this sort of the understanding of what this is good for. I mean, as much as I would love to, sell projects for every bank in the world for Web3, if you can't find a real problem to be solved with this technology, then don't. Really, I mean, it's technology for technology's sake is the worst use of time and energy you can possibly have, and money. So just don't FOMO. FOMO is a risk. FOMO is the fear of missing out. If you don't see a business reason to tackle any of this with the Web3 technology, just don't. That in itself is a risk. So don't FOMO. Really think through what the decisions are. Have a decision framework to actually tackle these things, and don't jump on the first opportunity that comes to mind. Right? If you're offered, a partnership with a crypto company, make sure that this speaks to your strategy. Don't just do stuff that's opportunistic, but it will stray you from your strategy, because you still owe your stakeholders and shareholders some form of transparency of what you're trying to do, and your regulators. So just don't FOMO. Don't buy the first NFT that crosses your path, right? Just understand what, as a business, understand what that means to you and your strategy. And if you don't have a strategy for whatever reason to use these new technologies, then maybe it's the time to think about one. But don't FOMO. Don't just like it's if you FOMO, everything else is a risk, right? So I think that is probably the but obviously experiment. As long as it's part of your strategy, experiment. Make sure that you understand the implications of the risks and obviously the opportunities of actually tackling Web3.
Yeah, great. I think that's really sound advice. Thank you for that. We're already 35 minutes in, but I do want to leave the conversation just with one more question, which is the report, which we're going to link to in the show notes, of course, is more than 70 pages long. So this is a tough one. But if you could summarize it in just a few lines, like how Web3 is shaping the future of finance, just to close the conversation, that would be fantastic.
I think Web3 is adding 4 things to the future of finance, which we call it the concepts, right? The technologies are primitives, wallets, tokens, smart contracts, and blockchains. But the way Web3 addresses ownership in ways that you own your data, be it your identity, your financial data, or your assets, is a real game changer. It's a change in the center of gravity of finance. Right now, we all rely on third-party custodians of everything we do. The app on your phone that holds your credit card, it holds your credit card. It's not you, it's them, right? So I think there's a change in the center of gravity of financial services that the incumbents will have to come to terms with, because as these newer generations that are crypto natives are entering the market and entering the workforce, they will have different demands, and one of the demands is that they will have the need to own what they own, and that changes how we, as financial services providers, we interact with the customer base in a very dramatic way, and we need to understand that. We need to understand this new dynamic. So I think the ownership is one. Then obviously we have decentralization we spoke about here, programmability and composability that changes the way we can build stuff. But ultimately, ownership changes how we perceive what we're owed as individuals. So I think Web3 enables that in a different way that both fintechs, banks, and regulators will have to come to terms with, and real soon.
Yeah, that's a great summary. It's a fantastic report. It shares a lot of insights, so we'll be very happy to link to the report in the show notes. Mauricio, thank you so much for offering your time and your advice as well.
Thanks for having me. We appreciate it.
And best of luck with 11FS.